Okay, when we're looking for daily scalps or intraday session setups, we're looking for basically is a daily search for scalps and velocity. Now, what do I mean by that? Well, first we have to consider a few things. When we look at kill zones and contrast that with the fulfillment of ADR, what I want you to think about is the opportunities that exist when ADR is yet to be fulfilled for the day. Now, there's going to be days, as I've already stated before, where ADR does not fill by London close. It doesn't mean that that number is completely useless. It means that that number may be impactful at a later time. It could be the following day's session. But for now, I want you to look at this chart to the left. Okay, now if I were to ask you, what am I outlining here, or what's the diagram crudely depicting? Without a doubt, most of you would say, well, that's obvious, that's a buy day. It's a open, and it declines down into London, creating the low of the day. Then it goes into some consolidation, then it rallies up, then creates a buy after a stop run on a New York session low, and then rallies up to ADR high. And this is true. This is one potential outline that would be a match for. But it doesn't always have to occur that way, because the daily range can complete outside the traditional, what we know as the London Open to London Close, or Asian Open to London Close. I want you to consider if the ADR is unfulfilled basically by the stock market open at 9:30 in the morning New York time, how would London Close play out? What influence would London Close have? And I want you to broaden your expectations on how market makers paint the daily candle. I want you to try viewing the previous kill zone as you would the London Open Judas. Now, what do I mean by that? Well, as we learned in this mentorship, the Asian Open can be the catalyst for the lower high of the day formation based on its opening price. So the vertical dark line here, delineating a reference of our beginning point in time, we're going to think for a moment that this is the 0 GMT hour, or Asia's Open. This could be very easily that phenomenon here, where the opening, it drops down in the blue shaded area. That blue shaded area could be simply the Asian Open kill zone. The market could rally from that point on and then create a run down lower on a previous low intraday at the green shaded area, which would be actually London Open. Then it fulfills a ADR high before New York session open. Now think about what I just gave you. There's simple templates that you can go about looking at how price may unfold for the day, but notice what's necessary. You have to have a higher time frame bias. You have to know what institutional order flow is on the higher time frames. So if we are trading within the weekly, daily, and 4-hour, and they would be bullish ideally, in this condition here, we could be anticipating the opening at Asia's Open to create that down move or Judas, and then creating another solid buy after a stop run for offset accumulation in the London Open. Now, let's skip to another session. Okay, obviously we mentioned the traditional open at the midnight candle in New York, and then a Judas swing down, creating the London Open low of the day, and then the market trades up, has some measure of consolidation going into the New York session, and then it creates a run on a short-term low that was created during the London lunch. That stop run for offset accumulation could be the New York session low, and then it rallies to ADR high. That's an obvious classic scenario. But now think for a moment. Say average daily range has not been fulfilled yet, and maybe London you've missed, or maybe London was uncertain, maybe Asia's Open was uncertain, maybe it's been a larger consolidation, or just simply you didn't get a chance to sit down in front of the charts until just now, and that vertical line that begins our time demarcation, that represents the beginning of the New York session, or New York Open. That drop down could be the catalyst for the blue shaded area, could represent the New York Open. And then it rallies up into the green shaded area, which would be, in this case, London Close. Remember, London Close does not always represent a reversal or the high of the day. If the conditions of the marketplace are calling for higher prices, and for instance, say average daily range hasn't fulfilled, and we have not met a higher time frame premium PD array, this is what you'll end up seeing sometimes with the London Close. It will provide opportunity for you to see a retracement back intraday to a short-term low. It rallies when everyone else is expecting it to be done for the day, or it retraces lower. Okay, we would be looking for a continuation to go higher on a buy on a stop run. That would carry into later in the day. 2 o'clock in the afternoon New York time, or 3 o'clock in the afternoon when the bond market closes. I want you to think about another scenario. Think about London close to bond close, as we just mentioned here. Then we have the New York Open to London close. That's another scenario that could be unfolding here. The traditional London Open to New York Open, and then the Asian Open to London Open. There's 4 primary opportunities each trading day, every single trading day. Those 4 windows of opportunity exist for scalping. Now, it does not mean every single pair will have every single one of those conditions promoting an opportunity where you can make 20 pips or more. It does not. I'm not implying that. I'm stating that if you're going to be a scalper, it's in your interest to go through a handful, maybe 5 to 8 different pairs, okay, and looking for these times of the day for these opportunities using higher time institutional order flow. And you can, and I'm not stating this to try to do it and blow your account, okay, or create massive drawdown, because you're going to go nuts with the information. But I want you to practice looking at live market action and see if you can't ferret out an opportunity every single trading day. Now, begin with it in hindsight. That's how you begin with it. Go back and look at maybe 3 or 4, maybe 5 different pairs. Do all the majors against the dollar. And I guarantee you there's an opportunity in every one of these sessions that I've outlined for scalping. Those opportunities exist, at least one per day. Now, I know what you're saying. Well, which one is it going to be, Michael? I need to know which one it is, because I could be wrong. Yeah, you could be wrong. What, do you think I was going to give you the exact which you're going to pick every single time? No, that requires your analysis. You need to go through and find out which one has the potential to move higher. Which one, if we're bullish, which one's failing to go lower? Which one's making higher highs faster than the others? Which one has their ADR that has yet to be fulfilled for the day? Which one has not yet ran into a premium PD array on a higher time frame chart? Those are the markets that would have more likely to be a candidate for the scalp at that particular time. And again, it goes just like the sun follows, around the planet constantly. It rises somewhere else. You start with Asian Open and look for a move going into the London Open. Then London Open into New York Open. Then New York Open into London Close, and then London Close into the bond close at 3 p.m. at New York time. There's your scalping windows. What you're looking for is your PD array matrix to line up with that idea. The framework, conceptually, in a graphic depiction, when we're using offset accumulation, this is what it looks like. It does not matter which one of those kill zones we're talking about, because it's all basically the same thing. If institutional order flow is bullish, it will most likely unfold like this. And notice the shaded areas I have for kill zones. I already knew what you're going to think, and that's what everybody else thinks in the free tutorial stuff. Those individuals over there, they just think London Open, New York Open, that's it. But you need to think in terms of how IPTA delivers price, and that same mechanic is offered during the Asian Open, the New York Open, the London Close, and all 4 of those primary sessions that we've outlined. They're all there as potential candidates. So that means, let's say you're looking for an average of 15 pips each session. Each time you're looking for an opportunity like that. No one works 24 hours. No one sleeps for 24 hours. So there's no reason why folks in this mentorship can't find at least 1 or 2 opportunities a week where they can pull something out. The other condition is when the market comes back down into a fair value. And we see that market trade back down into what would be an optimal trade entry, a bullish order block. But the stop run, here's when this one unfolds. If we seen that initial drop down that would be seen in the shaded area, whatever that kill zone would be. And again, I'm not limiting your perspective to London Open or Asia's Open. I want you to think this way universally across all the time frames. If we're underlying bullish, if that blue session or the first trading session that you're following, if that drop down or Judas swing creates a stop run, say it runs out short-term lows and takes out the sell stops, then the next kill zone, we would not anticipate a stop run there. We would be for a return to fair value. Doesn't mean you can't get a stop run. It just means that the most likelihood is it's going to pull back for fair value there because the previous session had a stop run. When we look at offset distribution, all we're doing is looking when the market's bearish. Same thing. Everything's just reversed. I'm not going to force you into thinking this is London Open and New York Open. I want you to think in flexible terms that these kill zones are operable universally going forward. You have Asia's Open, London Open, New York Open, London Close. bond close ends the day, like you would normally expect for London close, cap the daily range. Bond close at 3 o'clock, that ends it. Why 3 o'clock? Because that takes into account for 2 o'clock effect when FOMC rate announcements or minutes come out, and that may be pushing price around until 3 o'clock when the bond market closes. And then redistribution and a fair value level. This would be an optimal trade entry, sell, or bearish order block, filling in a fair value gap, or liquidity void that would be seen as price rallies up. Now again, thinking in terms of the kill zones, okay, your scalps, this type of price action would be seen on a 15 or 5-minute basis. That's how you would interpret it as well. So you would start with Asia's opening, looking to a move into London Open. There should be a scalp in there. There should be a scalp from obvious London Open to New York Open. There should be a scalp from New York Open to London Close, and then London Close to the bond market close at 3 p.m. Now the one that's in that list that's last, London Close to bond close, that one again is going to be used when ADR has not been fulfilled, but price has stalled below a premium PD array or above a discount PD array on a higher time frame. So when you're bearish, if the market, for instance, we're looking at like this scenario here, say that green shaded area is the London close. That London close, we have yet to see the ADR low fulfilled for the day, and institutional order flow is bearish on the daily 4-hour. If we see that New York session rally, and that vertical black line would delineate what? The beginning of the New York session, or it could represent what? CME open at 8:20 a.m. New York time. So if we see those time periods, okay, and we're expecting lower prices and ADR has yet to be fulfilled, we can anticipate the London close time of day to present a continuation, and then the market drops lower. That condition is going to be there if the low that forms in the London close did not meet a higher time frame discount PD array. That means it has yet to really reach for what it's ultimately reaching for, which is a higher time frame PD array in a discount capacity. So there's only one caveat to all these 4 windows. London close, that one using it as a timing for continuation, that one's always going to be based on the higher time frame PD array matrix. If that level has not been achieved by London close, then you can anticipate this type of formation to occur. Now also, the London close, it may carry over all the way into beyond 3 p.m. Bond close. It could actually continuously trade on through, especially on the heels of an FOMC type thing. It can trade right on through into the Asia's open. And then Asia's open will end up capping the range or that initial move that would occur from the beginning of London close in the previous trading session. That move can continue that long. So if you ever do get an entry at London close, you want to take something off certainly by 3 p.m., but leave something on because you may get some follow through over the course of rolling into the new Asia's open in the next trading day.